Hi everyone and welcome back to the channel. With the Fed meeting this week, we're going to get to see where the Fed presidents think our economy is at. Some of them have been saying that they want to raise rates by 0.5%. That way we can put downward pressure on inflation and suppress the economy a little bit more. Others are saying that we should pump the brakes a bit and raise rates by 0.25% to see where we're at. How will this affect our lives and our economy? Well, let's get into it. Over the last couple of weeks, there's been a ton of news about how the Federal Reserve is going to proceed. On one hand, they've been saying for months that they're going to continue to raise rates or keep them high until they see inflation is at or going towards their 2% goal. On the other hand, there's been a lot of economic indicators that's showing that inflation is starting to go down and that their economic policies are starting to work. Unfortunately, the Fed's always looking in the past and can never see what the future is going to hold, so they're always working with past data. Let's look at some of that data so we know how they're going to react. One of the main reasons the Fed might choose to slow down its rate increases is due to recent layoffs. In the tech industry, we've been seeing a lot of layoffs. Fortunately though, that has not been the case in a lot of other markets. I haven't really been seeing that, and I don't think the news has been saying that there's been any recent layoffs in any other markets. Shockingly, last week, we saw initial jobless claims decrease by 6,000 and continuing claims increase by 20,000. Overall, I'd say this is a good thing as we saw initial claims decrease, but it's not great that we're seeing continuing claims increase. That's because if you continue to see this, that means that people that are on unemployment aren't finding jobs and they're going to continue to sign up for unemployment. Another reason that the Fed might choose to increase rates by just 0.25% is because of the recent PCE data. Now I know a lot of you are familiar with CPI, but PCE is what the Fed looks at. Core PCE showed that inflation increased by 4.4% in the last year, which is down from November's numbers of 4.7%. Additionally, prices in November to December increased just 0.3%. On an annualized basis, that's just 3.6%, which is getting closer to the Fed's 2% goal. Now, one reason that the Fed could choose to raise rates by 0.5% is because of quarter four GDP. We have the early numbers now, and it's showing that GDP rose by 2.9% in quarter four. And yeah, that is great, but it's the slowest period we've had in about 2.5 years. So it is showing that the Fed's policies are starting to work, but not quite as fast as I think the Fed would like them to happen. And the main reason we're seeing this slowdown in GDP is because of debt. Consumer spending did show up positive on the last GDP report, but it wasn't really an increase and it didn't look good. Overall, this debt that's so expensive is causing a lot of people to not buy as much stuff. It's just too expensive to have consumer debt right now. People cannot afford it. And the Fed wants that to happen and likes the way that's moving. Unfortunately, I don't think it's happening quite fast enough, and the Fed's going to continue to push that to see if we can get GDP to slow down even more. Overall, if you're invested in the stock market this week and you're a long-term investor, you don't need to worry about too much of this. Yes, it's good to know and be up to date on this information, and you can stay right here. I'll always give you the updates on this stuff. But overall, it's not going to affect your portfolio that much. You have a long time to recover if stocks go down, and honestly, no matter which way the Fed goes, your stock portfolio is going to be okay. On the other hand, if you're a short-term investor or you're planning to get out of the stock market soon, maybe you're planning to retire, I'd be a little wary. If the Fed decides to increase rates by 0.5%, there's going to be a mass sell-off, as the market has priced in a 0.25% increase. So just be aware of that and make sure you're making informed, responsible decisions with your money and with your stock portfolio. If the stock market just isn't for you and you want a safe place to put your money, make sure you subscribe and hit that notification bell because our next topic is on CDs. If you did like this video, make sure you do hit the like button and leave a comment below. Otherwise, I'll catch you guys in the next one.